Welcome everyone to Tax Power Hour. Today's episode is owners' compensations, distributions, dividends, and guaranteed payments. This is a small business and self-employed webinar that includes tax tips and tricks to anyone that owns a small business or is self-employed. It's a monthly webinar. Today is July 5th, 2017, 12 p.m. Eastern, and this is the July episode. Today's content will speak briefly about Tax Power Hour and other recommended events that I'm involved with. We'll spend about 50 minutes comparing different entities with the context of compensation to the owners or distributions to the owners. We will spend about 10 minutes talking about the difference between compensation and a profit distribution. So we'll dig deep into that. Then we'll talk about the basis. And what does it mean to have a distribution above the basis? Then we'll briefly talk about loans to shareholders and what is the implication of having a loan to a partner or a shareholder or an owner of the business. And then we'll leave it open for Q&A and talk about other recommended resources. So what is Tax Power Hour? Small business self-employed tax tips webinar series, which some of you are attending live and some of you may be watching the video in YouTube later on after we post the recording. Our website is taxpowerhour.com. It's under construction, so that will send you into my personal website. And we have a Facebook group. Just search Tax Power Hour, where we want to build a community that helps each other and ask questions about tax. The webinar series is every first Wednesday of every month. Typically is 30 to 60 minutes long. You register once and then you will get invitation to all the episodes. We may come up with special episodes in which we have sponsored content or collaborated content with other entities that work in the tax industry. We do not provide CPE. This is not a CPE webinar. So if you are a CPA or enrolled agent, you're here for let's call it the fun of it, not for the continuing education requirements. And we will have discussions on tax law, changes to tax law. We'll do some practical examples. We may talk about tax software, payroll taxes, sales taxes, taxation on legal entities, or other related topics. That's kind of the general theme of the webinar. About myself, I'm the host of Tax Power Hour. My name is Hector Garcia. I'm a CPA. I practice in Miami where I have my firm, and mostly we do accounting, technology, tax planning, and management consulting. My email is hector@garciacpa.com. If you have any questions, if you want to have a question about tax, accounting, QuickBooks, whatever, I'm pretty good at answering emails, and I typically don't charge for emails, right? All right, so very important, because we're talking about tax and tax law, and I am a CPA, so in certain cases, people could misconstrue what I'm doing in this webinar as tax advice. So that's a really, really important point to make. This is not tax advice. I am not trying to give anyone tax advice. I am not allowed to give tax advice that is with the context of saying, this will pass or not pass muster in an IRS audit. So everything I'm saying is from my own personal opinion, and I could be wrong. I've been wrong before, and I've been told mercilessly via email and via comments anytime I make any sort of mistake. So because I am not talking about any specific case or giving anyone direct tax advice, this is not, don't take this as authority or specific tax advice. Now, I strongly recommend that you hire a tax professional if you don't have one. In the IRS website, you can search for Directory of Federal Tax Return Preparers with Credentials, and anyone that's registered with the IRS to prepare taxes, whether it is a CPA, an enrolled agent, or some other professional that's enrolled to practice before the IRS, that would be listed there. So definitely seek your own tax professional. Now, if you want to send me an email with some hypothetical tax questions, I can. But again, for your specific case, you should probably hire a professional. Now, some of the upcoming episodes we will have next month, we'll talk about retirement plans and deferred compensation. So we'll specifically talk about IRA, Roth IRA, 401k, and if we have time, we get into pension plans, which are a little bit more complex. Then we'll skip both the September and October episodes because of tax season. I get really, really busy during that time because of tax extensions. And then on November, we'll do international taxation, and that should be a fun one. And then in December, we'll talk about end of year tax planning tips. And those are all the episodes that we have scheduled for the year. Now, let's get right into the content. Let's start by comparing all the entities within the context. Again, this is within the context of compensation, okay, or distribution, or paying the owners in any way, shape, or form. So if you're a sole proprietorship, file a personal tax return with a Schedule C, or you have a single member LLC. That means you went to your state, you formed an LLC, and you didn't get any partners and you didn't make any special elections. Then basically you file your business activity under your personal tax return. All net income, so income minus deductible expenses, will be treated as self-employment income. So all business income will be treated as self-employment income that's taxable, and it doesn't really matter whether they took out a distribution or a loan or a compensation or payroll. Well, payroll is a little bit different. You technically shouldn't have any payroll if you're a sole proprietorship, but it doesn't matter how the owner takes money out of the business per se. It all will be treated as taxable income. So that doesn't really matter. The point is that if we're talking about a sole proprietorship, it doesn't matter. It's ignored. So we don't care if you want to call something compensation or distribution. Again, it does not matter. So if you file a Schedule C and you never deal with having a corporation or a partnership, then it doesn't matter whether you pay yourself compensation, distribution, whatever. It will all be treated the same. Now, let's talk about C Corps, which are the complete other side of the coin here. C corporations are very, very different. A C corporation has the context of what they call double taxation, which basically means that whatever net income a corporation has, so we're talking about income minus deductible expenses, that net income will pay an income tax to the IRS. And in some states, will also pay an income tax to the state. So you're going to pay income tax to the IRS, income tax to the state, and also income tax on your personal tax return if you're a shareholder, if you take a dividend. Some people call this triple taxation, but the concept really is double taxation because the IRS doesn't really care about the context of paying a state tax. That's more like additional tax, not another tax. But a C Corp will pay taxes, and if the owners take out a dividend, they will also pay a dividend tax. Now, most smaller C Corps, they qualified under what's called qualified dividend, which basically means it's a US-based C Corp, and the owner has ownership of that stock for 60 days before the dividend is declared and after the dividend is paid. That's what they call the 121-day holding period. So as long as you own that stock 60 days before the dividend is declared, then you will get a qualified dividend. So if we're talking about smaller corporations in which owners don't change stock and that sort of thing, then this is not really that relevant, the whole holding period thing, because the owner holds the entire stock for the whole period. This is more for publicly traded companies. When people trade stocks and stuff like that, this would be relevant. But for most smaller C corporations, it is highly likely that a dividend will be qualified dividend. So that means that they will pay a special tax rate on that dividend under this double taxation concept. They could pay 0%, they could pay 15%, or they could pay 20%, depends on what tax bracket they fall into. Now, if the individual shareholder takes out a dividend and they on their personal tax return fall under the 10 or 15% tax bracket, which is about, don't quote me on this, about $80,000 for a married couple. If they fall into that, then they will not pay a dividend tax. So that double taxation will not matter for that particular subset of group. The problem is it is very difficult to it's very difficult to know exactly what tax bracket the individual corporation shareholder will fall into unless you have visuals on all their own personal tax situation, their income and stuff like that. So if you're, for example, like myself, I'm a tax preparer for corporate tax returns, and the owners say, "Hey, I want to take out a dividend. What will I pay in tax on that dividend?" I cannot answer that question accurately unless I know what tax bracket they fall into. So that's one of the challenges with C corporations, is that dividends, you don't always know exactly what tax bracket is going to be, because it depends on the individual owner's tax bracket. But yes, they will pay. Essentially, they could pay double tax on the corporate side and tax on the personal side. Now, so that this is why most smaller corporations that qualify for what they call S corporation status, or subchapter S corporation status, make the actual subchapter S election. And there are some rules. They all must be U.S. persons, the owners, and you can't have more than 100 owners. So a public corporation can never be an S corporation, because in essence, they could have any sort of owners. But smaller corporations, in which again all the owners are U.S. persons, U.S. tax-paying persons, and doesn't have any more than 100 shareholders, then they could be an S corporation. And what are the advantages of the S corporation? One is taxation is at the shareholder level. So the S corporations don't pay tax onto onto themselves. So an S corp files a tax return but doesn't pay tax. The net profit, or the taxable income, is distributed, right? It gets distributed to each shareholder. Now, it doesn't have to be an actual physical cash distribution. We'll talk about actual cash distributions later on. We're talking about just the figure of taxable income, whether the money is still in the business corporate accounts or it gets transferred to the owner's pockets. That's not what we're talking about here. Just the figure of the taxable income gets distributed through a document based on the percentage ownership, and each shareholder will pay taxes based on their own tax bracket. So the S corporation won't pay the tax, but each owner will pay the taxes of the S corporation based on their percentage, because it got distributed. Again, not a physical cash distribution, just a paper distribution of that profit. So each owner pays their own tax. This gets distributed in a form called a K1. So the corporate tax preparer prepares the corporation tax returns, and they know who the shareholders are, and based on the percentages, they multiply that taxable income times that percentage, and that goes on the K1, letting the IRS know that the owner is going to pay the tax on that. Now, the K1 that distributes that profit to each shareholder usually will not pay self-employment tax, which is an other tax inside the personal tax return that really increases your overall tax bracket. Sole proprietorships and partnerships, when they pay themselves a compensation or a distribution or whatever you want to call it, all that stuff is subject to self-employment tax, which really increases the overall tax rate that you pay. This is why a lot of people like the S-Corps. Now, there are some exceptions in the S-Corp about paying your regular tax rate. Both partnerships and S-Corps have what's called pass-through income. So there are certain types of income like royalty and rental, which is called passive income, that also passes through on the same way. But forget about that. We're not going to spend too much time on that. So the S-Corp is typically the best entity for paying tax on distributions and profits, because they do not pay self-employment tax on that portion of the income. Now, the other side of the coin here is the IRS really wants to make sure that S-Corps are not used to circumvent the self-employment tax system. As a matter of fact, what the IRS really wants is to get a reasonable amount of compensation dedicated to wages for S-Corps. That way they withhold the Social Security and Medicare. But the reason why, or the underlying reason why most people want to avoid it, is because Social Security and Medicare, or better called the FICA tax, is 15.3%. So anyone that owns let's call it a partnership or an S corp would love to avoid that 15.3% of tax, which is again above and beyond the income tax, by setting up this S corp. So the IRS wants to make sure that at least some of the compensation goes through payroll, so it does get the Social Security and Medicare withholding, and especially with the political situation that we have now. We have, politicians, depending on what side of the aisle they're in. Some of them want to completely repeal Social Security, Medicare, all entitlement programs, and then the other half wants to increase or increase the amount of benefits that they pay, which means that the money has to come from somewhere, and taxpayers have to pay that. So the political situation doesn't help either. But from a fiscal responsibility situation, the IRS wants to make sure that at least some of the S corp profits are paying self-employment tax, which is why they have this rule called reasonable compensation. Won't get too much into the details of that, but let's go a little bit later on. Maybe if you want to ask a question about that, we can go deeper into it. Now, let's switch over to partnerships now. Partnerships are actually similar in certain ways and a lot different in other ways. A partnership is an entity that files a Form 1065, in contrast of the S corporation, which files an 1120S. But a partnership files a 1065, and this could actually be a partnership, or it could be an LLC with multiple owners that doesn't make any special election to be taxed as something else. That by default becomes a partnership. The partnership, in the same way as the S corp, gets taxed at the partners level. I put shareholder there, but I really meant to put partners level. Let me change that to partner. Okay, at the partners level, right? Usually we avoid using terms like shareholder in a partnership. We want to use the term partner. So a partnership gets taxed at the partners level. The next profit gets distributed to each partner, okay? And based on their assigned profit and loss percentage. Now, this is different than in S Corp. Pay attention now. S Corps have a fixed ownership percentage in which each owner can own. Based on what they own, that's exactly the percentage that gets distributed in their own personal tax returns as income. Now, in a partnership, partners can actually come up with a different profit and loss percentage across different partners, regardless of how much capital or investment, or let's call it percentage of the business they own. In other words, partnerships are flexible in which of the partners will pay taxes or which of the partners will take the losses. Now, we'll talk about excess distributions and stuff like that in a second, so just hold on that, because there's sort of guardrails around that. But generally speaking, partners can have you can have a 50-50 partnership, and one partner gets all the profit to pay the taxes, and one gets zero of it, or it could be any combination of numbers. Now, these partnerships, again, they distribute paper distribution, that net income to each partner. And what's tricky about this is some partners will pay self-employment tax, and some partners will likely not pay self-employment tax. Typically, the way it works is if a partner is active, they have active participation. That means they're involved in the activities that generates income for the business. That would be deemed as self-employment tax. And if you have a partner that's passive, it's just an investor, it doesn't have active participation, that percentage of distribution could pass on to that partner without paying that self-employment tax, and essentially getting almost the same amount of tax that you would as an S corp. So it is possible that some partners in an S corp will get the same taxable income as a S corp. So for some, S corp may not necessarily be the best. tax-wise. Partnerships could be about the same. The problem is you shouldn't, or normally you shouldn't have a partnership in which all partners are passive, like no one is paying self-employment tax. I've never seen that somebody claimed that before, and I also never seen that pass through an audit before. So I would say you have to have at least one active participation for this to make sense. Now, in a partnership, partners should not pay themselves payroll. So they should not pay themselves a W-2, withholding taxes, and all that stuff. Partners should actually be making estimated payments throughout the year, and their compensation should be coded as guaranteed payments. We'll talk about guaranteed payments in detail in a while, but any partner that gets paid compensation should be deemed a guaranteed payment. So we'll discuss that after we talk about distributions. And then, as I mentioned earlier, partnerships can have a different profit loss capital assignment, which is very different than the S-Corp. Now, this whole concept of self-employment tax, it's 15.3%, which is the same cost as FICA tax, which is 7.65% for the employee and 7.65% for the employer. But if you are an owner of the corporation, then you are both the employee and the employer. So basically what you see is that 15.3%. Anyway, let's move on to compensation versus profit distribution. Now, what we want to do here is draw a comparison to what is a distribution and what is compensation. Now, let's start with the premise that most partners or shareholders want to call money that they take out from the business, they want to call it or label it as a distribution. Let's call it that. For the most part, it may be the most efficient, tax-wise way to take money out, especially with an S-Corp. If you take out a distribution, you don't pay self-employment tax, where if you take out compensation, you do pay the FICA, Medicare, Social Security. So under the premise that everyone wants to code what they do as a distribution, let's talk about what may not be a distribution or what looks and smells like compensation. So we have a profit distribution versus a compensation. Okay, in a nutshell, most partners or shareholders want to take money out and they want to call it or label it a distribution. If the payment itself, again, it's disproportionate to the predetermined amount based on the K1, or above and beyond the capital, or it needs to be deducted before the calculation of the net taxable income, or it's connected somehow with performance, with work, that may be compensation and not a distribution. Now, let's get into some of the details of this. So, compensation, right? If we have a S-Corp and they pay themselves a W-2 salary, so they pay themselves via payroll, that compensation to officer reduces the taxable income of the S corporation. With partnerships, it's the exact same way. If you have a partner and you label a payment as a guaranteed payment, you will reduce the taxable income of the partnership. The individual partner that gets the guaranteed payment gets an increase in taxable income, but the partnership as a whole gets a reduced amount of taxable income. And we'll do an example of that with numbers, which should make a lot of sense. Then we have C corporations. So in a C corporation, when you pay a dividend to one of the shareholders, to one of the owners of the corporation, the taxable income does not go down. So you still pay your taxable income, your tax on the taxable income of the corporation, even after you pay dividends. With the S corps is also the same situation. A distribution does not reduce a taxable income. Partnerships, same thing. If they call it a distribution, does not affect taxable income. So it's really, really important to know that when we talk about compensation, where each of the partners or shareholders or owners will get income, right, that goes straight to them and they will pay taxes on that themselves, then that reduces the taxable income of the corporation or partnership. But if it's a distribution or a dividend, the taxable income of the partnership stays intact, and it obviously will be a lot higher compared to reducing the compensation to the owners for that. So let's do an example, and I think with a numerical example will make the most sense. So let's go through the example. We have a first year S corporation that has $30,000 in net taxable income after the shareholders pay themselves their salaries. There's a total of two shareholders. Mike owns 70% of the corporation and Steve owns 30% of the corporation. Naturally, Mike put 70% of the capital, 7,000, and Steve put 30% of the capital, 3,000. Now, Mike had a salary of $20,000 that we paid via payroll W-2, and that number was deducted from that 30,000 of net income. So that 30,000 net income for the S corporation is after these guys pay themselves their salaries. Now, Steve had a salary of $50,000, so Steve got paid more. Even though Steve has a smaller percentage, he got paid more because I guess he did more work or whatever it happens to be of the 50,000, and that again, that's already been netted from the net income. And he takes a distribution of 10,000. The question is, well, how does taxable income work? And what are the capital accounts of each owners? And that's a really important thing. You don't just calculate their taxable income, you always have to calculate their capital accounts. So what does this look like? So first of all, if we get the $30,000, we're going to assign 70% of that to Mike, right? And because he's 70% owner, so he's going to get $21,000 of quote unquote taxable income. This has nothing to do with the distribution they took. This is the net income of the company times his percentage. So Mike gets $21,000 of taxable income via the K1. Steve gets $7,000. Now, on Mike's personal tax return, he will pay taxes on the $21,000 of taxable income and the the 20,000 he got via salary. So Mike is essentially going to pay taxes on $41,000 of income. 20,000 that came through W-2, he paid Social Security and Medicare on that. On the $21,000 that he gets via the K1, he doesn't pay Social Security or Medicare, so he'll only pay $41,000 on his tax bracket, and then that $20,000 paid the 15.3% self-employment tax, half paid by the corporation, half by Mike personally. Now, Steve, how does Steve work? Steve got his salary for $50,000, so he'll pay taxes on that, and he'll pay Social Security and Medicare on the $50,000. That's probably already got withheld through their payroll system. And then the distribution for Steve, which is 30% of the 30,000, ends up being sorry, that's not 7,000, that's 9,000. What's wrong with me? That's 9,000. Whoops. Let's just do here 9,000, and that's $2,000. Okay. Just notice the calculation. So he'll get 30% of the 30,000, which is $9,000 of taxable income. Now, how do their capital accounts work? Well, let's say Mike started with $7,000, right? So he is going to have his original $7,000 plus the $21,000 that he got as a paper distribution, minus the $25,000 he got in actual distribution. His capital account has $3,000 left. In other words, that means he could still distribute $3,000 out of the company next year or whatever, and still have capital and will not have a capital gain of any sort. Steve, same situation. He started with $3,000. Then we have the $9,000 that were added via the K1, which is the 30% of the 30,000, minus the $10,000 he took out. He's got $2,000 of capital left. Okay, let's do another example. Okay, let's do a partnership. Okay, partnership will be a little bit trickier, but it's a similar situation, but it will be a little bit trickier. Okay. Okay, in a partnership, is it okay for a partner to receive monthly that we label as quote unquote management fees? That's an interesting question. So if a partner gets a payment called management fees, that is what you call a guarantee payment. So the question is it okay? The answer is yes, of course, it's okay. Now, the other part is it taxable? So I would say the answer is yes, of course. This is going to be taxable as a guaranteed payment. Okay, so just to give you, that's the answer on that. I'm making made some of the spelling corrections onto the slides. So I'm going to remove the slides from the handout section and upload the slides with the corrections. I'm also going to email, so don't stress about that. I'm also going to email the slides to everybody that's on this list that has all the corrections. So I'm sorry that there were some spelling mistakes. I've been super busy and maybe didn't get a chance to take a look at all that. Okay, so I got 96% of the votes on the poll, and let me go ahead and close the poll and switch back to the slides. I'll share the results real quick just kind of get an idea. So we have about 15% of people already knew the content. So let's see if maybe with the other slides we have, if we have any opportunity to show you something new. Okay, let me go ahead and hide the results here, and let's go back to the slide that we were in. So we were at the partnership slide. Okay, perfect. Okay, you should be seeing my partnership slide now. Now, we have a first-year partnership that had $100,000 of net income. This is before we label anything as guarantee payments. And there are two partners. John has 20% of the partnership. Robert has 30%. Let's say that also both partners have the same exact percentage that's assignable for the profit and loss and the capital percentage. So they don't have a different percentage. It's just 70 and 30. That's what they have. Now, John takes compensation of $45,000, in which they both agreed that 20% of it will be called a guarantee payment and 25% will be called a distribution. This is because this is what they agreed to, that John earns $20,000 based on the work that they do, and let's say, for example, for whatever reason, the distribution is $25,000. Steve, let's say he takes a guarantee payment of $50,000. Now, why $50,000? Because that's what they agreed, that Steve was going to do more work or whatever. And then he takes a distribution of $10,000. Now, so Steve took a total of $60,000, and John took a total of $45,000. Okay. Now, they got together and they called the $20,000 guarantee payment and they called $50,000 guarantee payment to each of them. Because they did that, and there's no rule that tells you what can or cannot be a guarantee payment, with the exception of something written that's preset, in which they agreed to before the partnership starts and all that stuff. But if they don't have such a thing, they basically chose what they want to call what. Now, what is the taxable income and what are the capital accounts? Well, let's do the calculation. So now we had $100,000 in net taxable income. One of the partners took a $20,000 guarantee payment. The other one took a $50,000 guarantee payment. So now we have a total of $30,000. That's our new taxable income. Now, John owns 70% of that, so we just multiply 30,000 times 70, so that gives us 21,000. That's what is the taxable income via the K1. But also, he took a guarantee payment of 20,000. So in the K1 itself, there will be a note saying, hey, they also took $20,000 in guarantee payments. So now $41,000, similar than the last example, $41,000 is a taxable income for John. Now, Robert takes a $30,000 taxable income, a $9,000 taxable income via the K1, again, which is 30% of the 30,000, and then he takes his guarantee payment. But their accumulated accounts are going to be very different, because in the world of partnerships, guarantee payments are actually part of their capital accounts. So John started with 7,000, then got a K1 for 21,000. That's not a cash distribution. That's a paper distribution based on the K1, plus its actual cash distribution, which we called it a guarantee payment, minus the $25,000 um, in um, in actual cash distributions. The net capital is $23,000. So John has a capital of 23,000. Now Robert, which is interesting, he has the $3,000 he started with, plus the $9,000 of, again, paper distributions via the K1, plus the $50,000 in guarantee payment that they agreed to, minus the 10,000 distribution. He ends up with a capital of 52,000. So the capital account calculation on a partnership is very different than in an S-Corp. And the reason why this matters is because, generally speaking, while the capital account is positive, it's not a problem. But once the capital account comes down to zero or negative, then you may have to change what you call a guarantee payment, or the individual owners can take a capital gain on that negative accumulated capital account. So owners, partners cannot have a accumulated capital accounts are negative, or they shouldn't anyway. The other reason why this is important is because if they turn around and sell the partnership, John has $23,000 in capital, Robert has $52,000 in capital. This means that whenever they sell the partnership for whatever they sell it, the first $52,000 that they get will not be a capital gain, because it's part of, for example, for Robert, it's part of his capital. And for John, the first $23,000 he gets for the partnership, it will not be a capital gain. So that's a really important part, really only for when you go ahead and sell the corporation or the partnership, or whenever this goes down to zero. In other circumstances, the capital account is just there to keep control of who's taking what out. Okay, now let's talk about what we call a distribution above or in excess of basis. This means that what could potentially bring my capital account to zero. But it's really important to understand how the calculation works. So the basis, or my capital account, depending on from what angle or point of view you're looking at it, but let's call it the capital account, is going to be what the owner or partner puts in the corporation, what they call a contribution, minus the distribution, so what they invest and what they take out, that's called a distribution, plus any accumulated taxable income that gets distributed via the K1, minus, in the same cases, let's say the partnership or corporation has a loss, minus whatever loss it could produce via the K1, plus any guaranteed payments that the partners get. So this is how we calculate the basis for each partner. Now, what you're looking at here, it's the same for S-Corp and partnerships, with the exception of that last line, guaranteed payments. Compensation to S-Corp owners via payroll, W-2, anything that goes through the payroll system, does not become part of the capital accounts, where in a partnership it does. And this could matter when you're doing tax planning. This could matter. It doesn't always matter, but I'm saying it could matter, and explain the reasons why. Now, as I mentioned earlier, partners and shareholders should never have a capital account of negative, or if they do, make sure it's a very temporary thing, or it's not a significant amount that the IRS is going to put pressure on you to reclassify as compensation or make it a capital gain. If a distribution, it's going to create a negative basis. So once you know what that basis is before you make a distribution, then you may consider reclassifying as payroll, compensation, or guarantee payment. Again, otherwise it may be treated as a taxable capital gain. Now, let's talk about guarantee payments specifically. And a lot of times, the whole word guarantee payments is confusing, and people get confused by the whole concept. So let me break it down. It's very, very simple. Guarantee payment is not a thing. You don't get a W-2 form. You don't get a 1099 form. This is not something that's tracked via the traditional compensation documents like a W-2 or 1099. A guarantee payment is something that's internally agreed by all partners. Now, generally speaking, when the partners say, I will make X amount and you will make X amount, you will make Y amount, whatever it happens to be. And it's something they pre-agreed to, and it's in exchange for services provided. That's absolutely a guaranteed payment. Now, if there's profits or there isn't profits, and a partner is still guaranteed to get a specific dollar amount, that is a guaranteed payment. If you're making a payment before calculating the amount of profits that partners can get, so if it's a payment prior to profit distributions, that is a guaranteed payment. Guaranteed payments will be taxable income to the partner. And in most cases, not all, but in most cases, the partner will pay self-employment tax. Now, the nice thing about guarantee payments is it reduces the taxable income. Now, I'm going to tell you when a guarantee payment makes a lot of sense. When you have partners that have different ownership percentages, but one of the partners is going to get paid a lot more than the other partners, and it's also disproportionate to their percentage. You always want to call that guarantee payment, because otherwise it will make it unfair to the other partners. Because if you don't reduce your taxable income with that guarantee payment, you may have a partner that has a very small percentage pay a disproportionate amount of taxes, because a whole different partner is taking the distributions that this partner that has a small percentage cannot take, because for whatever reason they're not distributing, or they're not taking, or he's not taking a guarantee payment, right? So again, guarantee payments, if you got any particular partner getting a disproportionate amount of distribution or compensation, you may want to call that a guarantee payment. Okay, so let's switch gears here to loan to owners. Loan to owners. Now, the reason why it's important to talk about loan to owners is because a lot of people just want to call uh, payments to owners, they want to call it a loan and say, don't worry, we'll pay it back. Let's talk about the rules in which you could technically have a loan to an owner. Well, one is it has to be a proper loan. So it needs to have documentation. It needs to be within means. It's something that you have reasonable belief that you will get paid back as a loan. So it's, let's call it's underwritten, right? In some cases, and you will get paid back within a reasonable amount. You cannot tie a loan to compensation. So, for example, if you tell someone that, hey, if we make $200,000 this year, I'll be able to lend you 50,000. So you can't tie it to activity. You can't tie it to a reward. Right? So otherwise, it wouldn't be a loan. It has to be, again, a proper loan. Again, which you're going to get paid back in a reasonable amount of time, and there's reasonable belief that you could get paid back. And also, the owners must pay interest. So you have to have interest accumulated on that loan. And usually the IRS is not okay with you just accumulating the interest and adding it back to the loan. Like, you want to make an actual loan payment, or at least an interest payment, to show that this is let's call it a proper loan. Okay, let's do Q&A. So let me see. We still have about 10 minutes left, so that's good. So let's go through the Q&A. Let's see. Somebody says, can a partner issue himself a 1099 from a 1065 return and also report a guarantee payment? So that's a question from Amy. Well, I would say that I have not seen a rule that specifically prohibits a partner from getting a 1099. However, it is not normal. What's usually normal and expected is that it all goes through guarantee payment. But I think in form, if you're still going to pay the taxes no matter what, that could work. But it technically should be guaranteed payment. So again, you could pay yourself a 1099 on top of the guarantee payment, but the correct form is a guaranteed payment. Okay, Susan says, who keeps track of the capital accounts? Well, technically it should be whoever runs the books, the accountant, the internal bookkeeper. I mean, at the very least, the tax person should. Okay, I mean, I don't see any reason why the tax person shouldn't do that. So the answer is the tax preparer at the very least. Um, I always get confused the difference between the book percentages and that are different for tax percentages. Renee, I'm not sure exactly what you mean by that question. I'm going to attempt to answer it this way. Um, with a partnership specifically, you can have an agreement that um, that uh, that that you're 50-50, but internally one person can get 80 and the other one can get 20. So your book percentage, I assume, is the capital ownership of the business, and that could be different than the actual distribution amount. So I would say that just keep in mind that it is very possible. It's very plausible for a partnership to have a different percentage for that. So I would say, don't get confused about it. That just happens to be the case, that people can have different ones. Let's see what else we got here. Somebody says, where can I get more information on partnerships? Denise, I would say the IRS website. I really don't know other than that what else I could tell you. Let's see. Another question is, Harold, if distributions were made on 2015 and there were dividends and no 1099 DIV was issued, should I issue a 1099 dividend now? Harold, you're talking about a C Corp that paid the owners dividends. I would say that if each of the owners actually filed a proper Schedule D form, or they've actually claimed their dividend income, if that has been done. So if they have actually claimed the dividend income already, and that has been done, that has been properly done, then I say I wouldn't bother filing the 1099 dividend. But I actually think the IRS will have a different opinion on that. So I don't want to call that or deem that a tax a tax suggestion. I would actually look at the circumstances. But I would say you should always file the 1099 DIV for dividends no matter what. But I would say if the owners did pay their taxes already, I wouldn't bother with it. Let's see. What would your recommendation be for a new bookkeeping and tax business owner when creating their own business? Like, I guess your question is the entity. So Shanita, I would always recommend an S-Corp, as long as you have the responsibility and the willingness to do your payroll, to actually do the payroll. I would say an S-Corp is usually the best case. But if you don't really want to bother with payroll, then leave it as a single member LLC, and just file under your personal return, right? You will save taxes with an S-Corp and with payroll. Another question from Curtis. What do I do about a partner with a large negative capital account in the past few years? Curtis, I would claim that as a capital gain, or force the partner to take huge guaranteed payments that are not really physical movements of money, guarantee payments, to increase their capital accounts and make them pay the taxes on that, because they technically have a tax liability. Donna saying, we have partnerships that have different capital accounts for book purposes, and they are GAAP and they're reviewed financial statements, and cash for tax. Okay, I see. Donna's actually kind of maybe explaining the reason about the difference between book percentages and tax percentages. Okay, so that wasn't a question. Okay, do shareholders who loan the business have a lump sum payback check? I have a client who loaned money to a business, then keeps taking money from business to personal and calling them shareholder. Is that allowed? Susan, I would say email me, because I didn't understand the nature of that question. Hector at garciacpa.com. Maybe I can ask you more details about that. Would love to answer it, but I just didn't really understand the moving parts of that question. Okay, I guess that's it. Let me just talk about the other slides that we have here. And I'll run one more polling question. I just want to see if for the people that said no, maybe I got to sway a few people on that. So just let me know if there was maybe something new that you learned in the process. And it's important for me to know. Uh, I mean, I don't know what the audience is. I mean, I have to look at the polling question at the beginning. Some of you that attend this webinar live are actually accountants or bookkeepers or tax people. So it's difficult to teach you something new if you are in the field. But if you're watching this webinar, the recording in YouTube or whatever, it is highly likely that some of you are not tax people or accounting people, and they're business owners. Um, and maybe a lot of it would be new. So I just want to know more or less whether or not I am giving some new information. And we're almost done. I'm going to just talk about the other webinars that I have coming up, just in case you're interested in attending. And we'll finish at 1 p.m. Eastern on the dot. So it'll be exactly an hour. I try to avoid making the webinars any longer than an hour. So please answer that last polling question if you don't mind. Okay, we got about 85% of the votes. I'm going to go ahead and close the poll. Okay. All right. So the other webinars I'm involved with is the largest of the webinars is called QB Power Hour. That's going to be not tomorrow, but next Thursday. And that's every other Thursday. That's a webinar series. Go to qbpowerhour.com to watch all the episodes. We have almost 70 episodes already, and subscribe to be part of that webinar series that actually gives you CPE. So if you're an accountant or any accounting professional that needs continuing education credits, that would be good. And then on Wednesday the 19th, that's going to be a busy, busy day. Mark your calendars. We have 3 webinars back to back. We have a webinar at noon called Why Upgrade to QuickBooks Enterprise from Pro and Premier. That's mostly for people that are working with Pro and Premier and they're considering going to Enterprise, or they're outgrowing QuickBooks Pro and Premier and they are considering Enterprise. So we'll discuss all about the features, the pricing, and whether or not it'll make sense. Then at 2 p.m. Eastern, I have a webinar called Data Conversion Pro. It's a webinar about converting data into QuickBooks. So getting data from Excel, from PDF into QuickBooks, and we'll go in depth on converting bank data that could be in a CSV file, it could be in a QBO file, it could be in any sort of weird bank download, a PDF statement, and how to convert that to import that into QuickBooks and save a lot of manual data entry time. Then at 4 p.m. we have Small Business Power Hour, which is a webinar series mostly about marketing and small business content marketing, that sort of thing. We're going to have a segment that it's all about blogging and content marketing. So we'll talk about WordPress. We'll talk about the power of writing articles and blogging, and how that helps your organic search. And then on August the 2nd at 2 p.m., we will have Excel Power Hour, which will actually be on pivot tables. The title, it's wrong there. The title will be on pivot tables. So originally, we were going to have it today at 2 p.m., but we have a guest that canceled, so we'll not be having an Excel Power Hour this afternoon. So that will be August the 2nd. And that's it. Stay connected. Join the Facebook group. Email me if you have any questions. And that's it. Thank you very much and have a wonderful day.